What if I told you that Warren Buffett didn't get rich by picking stocks? What if the truth is he never even cared about the stock market the way that you think he did? Because the real story is Buffett didn't just invest in companies. He was buying control and then getting paid whether the market went up, down, or sideways. And while the rest of the world was obsessed over finding the next big thing, Warren Buffett just kept making money without ever needing the market to help him. So what was the real secret? How did this 11-year-old kid from Omaha, Nebraska build the world's most powerful financial empire? And what can you take from his playbook to start building your own wealth today? Well, in this video, we're going way deeper than the surface level stories you've heard before, beyond the myths, and I'm showing you exactly how Warren Buffett built his fortune, the strategies he used, the deals he made, and the 3 timeless principles that'll change how you look at investing forever. This isn't the Warren Buffett you've been told about. This is the Warren Buffett you don't know, and the lessons that can transform your entire approach to investing. For those of you who are new to the channel, my name is Danny Gould. I'm the CEO of Gould Capital, and over the last decade, I've overseen over $250 million worth of real estate transactions, as well as co-managed a $300 million hotel portfolio. And in that time, I've had the opportunity to interface with dozens of ultra high net worth investors, billionaires, leaders of some of the most prestigious family offices, but none of those people quite stack up to Warren Buffett. And so a couple of years ago, I made it my mission to learn more about Warren Buffett and understand exactly how this man thinks. And this video is the culmination of all of that research. Be sure to stick around till the end of the video where I share with you the 3 greatest lessons that I have learned from Warren Buffett and how you can apply it to your own investing journey. So let's get started. Now, in the last video, we covered Warren Buffett unlocking the concept of insurance float. And that was really the Pandora's box that allowed Warren to scale.
One of the most successful investors of all time with Warren Buffett. Warren Buffett bought
Geico for 2 reasons. Number 1, it unlocked his ability to tap into insurance float to buy other companies using money that he didn't even have to borrow. And number 2, Geico's direct-to-consumer model was super low overhead, which allowed him to use more float faster. Geico wasn't just another holding for Berkshire Hathaway, it was the engine that made every other holding possible. It's the reason Warren Buffett stopped trying to beat the market and started building one of the greatest financial machines in history. Now, most people look at Warren Buffett's success and focus on the big wins: Coca-Cola, Apple, Geico, but what really made his fortune wasn't just picking good companies. It was staying rational, especially when no one else was. And you see that most clearly during the moments and periods of crisis. Because Warren Buffett's biggest moves didn't happen in bull markets. They happened when the world was on fire, when everyone else was panicking. Let's rewind to the 1970s. This was a decade of chaos. It was an absolute grind. The market was going nowhere. Pessimism was at an all-time high, and Buffett's approach was to not chase the facts. While many others pivoted into oil stocks or emerging tech, Warren Buffett stayed the course. He continued to stay focused on businesses that generated consistent cash flow and had pricing power. And for nearly a decade, Warren Buffett underperformed. Wall Street analysts said he was washed, that value investing was dead, and that the new economy had passed him by. But Warren Buffett didn't flinch. He just kept on buying boring, cash-generating businesses. He kept stacking float from his insurance holdings and quietly kept building Berkshire Hathaway into a cash machine. Now, fast forward to 2008. This was the moment Buffett's strategy proved its worth. Lehman Brothers collapsed. Bear Stearns was gone, and every major bank in America was on the brink. Markets were in a free fall. Retail investors were dumping everything that they owned. Even institutional money was frozen, paralyzed by uncertainty. Buffett was writing checks. He invested billions of dollars in companies like Goldman Sachs and General Electric. He structured and customized these deals to have extremely low risk for him and incredibly high upside. Because when everyone else was forced to sell, Buffett had the ability to buy on his terms at his price with built-in protection. This isn't luck, this isn't timing, this was strategy. He ran Berkshire Hathaway like a fortress, cash-rich, flexible, and focused on the long game. And that's why in moments of panic, Buffett wasn't a victim. He became the buyer of last resort. And that's where the real money is made. Not in bull markets, not in hype cycles, but in moments of maximum fear, when assets are cheap and sellers are desperate. And here's what's important. This is what I want everyone to remember, is that Buffett didn't try to predict the crash. He just made sure that he had temperament and the capital to act when it happened. That's his edge. The world might think it's IQ or stock picking mastery, but the truth is that Warren Buffett's edge was emotional discipline applied relentlessly for decades. He once said, "The market is there to serve you, not to instruct you," and that's exactly what he did. He used the panic of others as a tool while staying completely unemotional himself. Now, this is a fantastic segue into the 3 biggest lessons that I've learned from Warren Buffett. Now that you've seen how Warren Buffett built his empire, it's clear that his approach isn't just about picking stocks, it's about creating wealth through strategic ownership and steady long-term growth. But what exactly makes Warren Buffett so effective? Let's dive into the 3 timeless secrets that set Warren Buffett apart and can transform the way that you think about investing forever. Now, many of you have probably heard this infamous Warren Buffett quote before, which is, "Be fearful when others are greedy, and greedy when others are fearful." It's perhaps Warren Buffett's most famous line, but almost nobody lives it. Because when fear hits the market, logic goes out the window. Let's go back to September of 2008. Lehman Brothers just filed for bankruptcy.
Lehman Brothers filed for Chapter 11 bankruptcy.
158-year-old institution gone overnight. The Dow Jones dropped 500 points in a single day. Panic was everywhere. News anchors were openly asking, is this the next Great Depression?
We're down over 16%. Dow at the same time has fallen about 18%. The stock market is now down 21%.
Because we're now down 43%.
Banks weren't lending. The credit markets froze. Nobody knew who would fall next. It was fear. Real systemic fear unfolding in real time. And retail investors were selling everything. Fund managers were hoarding cash, and even the big players, pension funds, endowments, sovereign wealth funds, were just trying to survive. It was in this very moment that Warren Buffett made his move.
The firm of Goldman Sachs is a high-profile survivor of the recent carnage on Wall Street, thanks in large part to a $5 billion investment by Warren Buffett.
$5 billion into Goldman Sachs. This was not structured as a bailout, but as a strategic, custom-structured deal. He wasn't buying common stock on the open market. He negotiated directly with Goldman Sachs board on his own terms. He got preferred shares paying a 10% annual dividend. That's $500 million a year in cash flow just for waiting. Plus, he got equity warrants, the right to buy Goldman stock later at a fixed, depressed price. So if the company recovered, he owned the upside. Same thing with GE, $3 billion in preferred shares, another 10% yield, more warrants, more upside with consistent cash flow in the interim. This wasn't just buying something cheap. He was building downside protection into the deal. He got paid to sit there while these companies' recovery played out. That's not just smart investing. It's poised financial engineering in the middle of an absolute dumpster fire. And the only reason that he could do it is because he had the liquidity when nobody else did. You see, most investors think that this game is about returns, but Buffett knew that it's about position. Where are you when the music stops? So in 2008, Buffett wasn't on the sidelines. He was at the negotiating table while everyone else was begging for mercy. Many years later, in response to the 2008 crisis, Warren said, "Opportunities come infrequently, but when it's raining gold, reach for a bucket, not a thimble." He was executing a plan that he had waited for years to deploy. He understood something fundamental. You don't make your fortune during the boom. You make it by being ready for the bust. That's what the secret is really about. It's not just be greedy when others are fearful. It's have the structure, the cash, and the calm to act when fear takes over. Buffett wasn't fearless, but he was prepared. Warren Buffett's focus on cash flowing businesses was just the start. But the second secret is where he really separated himself from the pack. Most investors chase the upside, the big, flashy, home run grand slam deals. Buffett, on the other hand, chased something far more reliable, cash flow. While others flocked to flashy IPOs, booms, and risky startups, Warren Buffett stayed grounded and always asked one simple question. Does this thing produce cash year after year? Starting with See's Candies. In 1972, Berkshire bought it for $25 million. Now that price was steep for a regional chocolate company, and on paper, maybe it didn't look like a value buy, but Buffett saw something deeper. See's had 3 things that don't show up on a balance sheet: pricing power, customer loyalty, and minimal reinvestment needs. Translation: See's could raise prices every year without losing customers, and it didn't need new factories, new product lines, or massive R&D budgets to keep the money coming in. Buffett didn't have to guess what the business might become. He could see right then that it was a toll booth. Every holiday season, See's Candies became a cash cow. And over time, it produced over $2 billion in profit on a $25 million investment. That is an 80x cash-on-cash return. And all Warren Buffett had to do was sit still. Now, let's talk about Coca-Cola. Buffett started buying Coca-Cola in the late 1980s after the 1987 market crash. While everyone else was selling, he was loading up. And today, it's one of Berkshire's longest held positions. So why Coca-Cola? Well, simple. It sells sugar water at a premium, and no one questions it. It's a global brand, the margins are high, and the consumption is habitual. People don't think about buying Coke, they just buy it when they go to the grocery store. And in 2023, Berkshire's annual dividend from Coca-Cola was over $700 million. That's just the dividend, not the appreciation. Buffett's total stake cost him about $1.3 billion, so it's $700 million a year in dividends. He's getting a 53% yield on his original investment. That's what happens when you buy cash flow machines, not hype trains. And then let's talk about Apple.
Billionaire investor Warren Buffett, apparently he still has faith. His company, Berkshire Hathaway, recently purchased more than $1 billion of Apple stock.
Warren Buffett didn't touch tech for decades. It was too complex and it was too unpredictable. But in 2016, he made a move. Not because Apple was a growth rocket, but because it had something that he understood. A sticky ecosystem, recurring revenue, and brand loyalty so strong, people upgrade every year without even thinking about it. He didn't buy it like a tech stock. He treated it like a consumer staple. As of now, Apple is Berkshire's largest holding, worth over $150 billion. And the dividends pay him over $800 million a year. Buffett calls Apple his third business pillar, after insurance and railroads. Not because it's trendy, but because it's reliable. See, the secret isn't about avoiding growth. It's about prioritizing businesses that generate excess cash without needing more cash to grow. Warren Buffett has never invested in dreams. He invests in machines, businesses that quietly compound while everyone else is chasing headlines. He once said that time is the friend of the wonderful business and the enemy of the mediocre. What he means is this: if you buy something great and just hold it, the numbers eventually become absurd. Not because of some complicated strategy, but because the business was compounding cash. And that's a great test for every investment that you make. Does it generate consistent cash flow year after year? Or does it need constant reinvention and new capital just to stay afloat? Buffett bet on cash, and the cash kept on coming. Now, while Warren Buffett's focus on cash flow gave him a unique edge, it's the third secret that truly set him apart in my mind. Because people often point to Buffett's IQ, thinking his brilliance lies in his ability to analyze numbers or read a balance sheet faster than anyone else. But the real secret wasn't his intelligence, it was his temperament, because temperament beats talent. He stayed calm when others panicked. He stayed skeptical when others got greedy. And most importantly, he knew when to do nothing. And that's not easy, because most investors can't sit still. How many investors do you know that check their portfolios like 20 times a day? They get FOMO when their friends are chasing the next big trend, and they sell way too early when the market dips. They buy way too late when it rallies. Buffett wasn't wired like that. Let's look at the dot-com boom. From 1995 to 2000, tech stocks were exploding. Anything with a .com in its name could literally go public and double in value overnight. But Buffett sat that hype train out. Not because he didn't understand tech, but because the numbers just didn't make sense to him. The businesses didn't have enough cash flow. Sure, they had hype and momentum and lots of cash burn, but Buffett wasn't in the business of speculation. And for this, he was mocked relentlessly. CNBC pundits called him outdated. Institutional investors said he'd lost his edge. The market had left him behind. But when the bubble burst in 2000, Buffett didn't lose a dime. While others were down 70 to 90%, he was sitting on cash, waiting, watching, preparing, because that's the difference. Where others react, Buffett waits. He waits for what he calls the fat pitch, the rare opportunity where the value is so obvious, the price is so low, the value is incredibly asymmetric. And when that fat pitch shows up, he swings big. Here's how Warren put it: you don't have to swing at everything. You can wait for your pitch. The trick in investing is just to sit there and watch pitch after pitch go by and wait for the one in your sweet spot. That's temperament. And in investing, it matters more than timing, more than intelligence, more than any hot tip. Because markets don't just test your skill, they test your patience. As an investor, the market will bait you with fads, it will punish you with volatility, and it will tempt you to act when the best move is to do nothing at all. Buffett's genius wasn't that he knew what to buy, it was that he knew when not to buy. He avoided 90% of the noise, so when a real opportunity came along, he had the capital and the clarity to take. Most people blow up their portfolios because they're trying to do too much, but Buffett built his by mastering when to do less. And that's why secret number 3 matters, because long-term wealth isn't just about what you own, it's about how long you can hold it and how well you can sleep when you do. Temperament isn't a buzzword, it's the invisible discipline that made Warren Buffett Warren Buffett. At the end of the day, Warren Buffett didn't build his $80 billion fortune chasing stock tips or fads. He wasn't day trading, he wasn't gambling. He built his empire by following a framework, one that almost no one else has the patience or discipline to stick to. And it came down to 3 principles. 1, be greedy when others are fearful. 2, buy cash flow, not speculation. And 3, temperament beats talent. None of these require a PhD. It doesn't require inside tracks or a billionaire's bankroll. It just requires structure, it requires patience, and it requires a commitment to playing the long game when everyone else is chasing the shortcut. Now, here's the part that I'm here to tell you. You don't need to be Warren Buffett to apply the same framework to your investment strategy. You don't need $80 billion. You just need the blueprint and the willingness to act when others hesitate. And that's what this channel, Investing Secrets, is all about. I focus on diving deep into timeless investment strategies and secrets explained simply so you can invest with clarity and confidence. If you're tired of surface level advice and you want to see how real wealth gets built, make sure to hit the subscribe button, hit that notification bell to get notified every single time I post a video just like this one, because guys, we are just getting started. We are just getting warmed up, and you can rely on me to bring you the latest investing tips, strategies, and secrets. This is Danny Gould, everyone, with Gould Capital. I will catch all of you in the next video.